Parambali. Good afternoon, everybody. Today is the second session of Block 2, and the topic is absorption costing and marginal costing. Absorption costing is otherwise called the traditional way of costing, and it is otherwise called the full costing. In absorption costing, what happens? The total cost is computed by taking both the fixed cost and variable cost into consideration, but no material differentiation is being made between the variable cost and the fixed cost. In case of absorption costing, you can say it is a technique of calculating product cost, considering both fixed and variable cost without any differentiation between the two. Absorption cost includes direct manufacturing costs such as direct material, direct labor, and direct expenses, along with the fixed overheads. And overheads may be of three types. It may be factory overhead, it may be administrative overhead, and it may be selling and distribution overhead. But that absorption costing suffers from certain demerits. The first demerit is it assumes prices are simply a fluctuation of the cost, which is not materially true. The second demerit of absorption costing is it doesn't take account of demand into consideration. This is the second demerit of absorption costing. The third one is it includes past costs which may not be relevant to the pricing decision in hand. This is the third demerit. And the fourth and the last demerit of absorption costing is it doesn't provide information that facilitates decision making in a rapidly changing market environment. So taking these shortcomings or the bottlenecks or the demerits into consideration, the absorption costing is being discarded and an advanced method of costing is being taken into consideration, which is called the marginal costing. In case of absorption costing, what happens? Suppose the organization produces 500 dusters with a variable cost of rupees 5 as direct material, rupees 10 as direct labor, and rupees 6 as direct expenses. And it doesn't have any fixed or floating variables. The fixed overheads is say 10,000 for the entire setup. In that case, if the cost per unit or the cost of production of the duster is being calculated, then the direct material per unit would be 5, direct labor would be 10, and the direct expenses would be 6. So the prime cost would be 21. And well, the fixed cost would be consideration. The total fixed cost is 10,000 and the number of units is 5,000. So the fixed overhead per unit is coming 2 per unit. So the total cost would be obviously 23. This is what the absorption costing is. But when we take the marginal costing into consideration, marginal costing means it is a technique which is concerned with the changes in costs and profits resulting from changes in the volume of output because of variable cost. It gives a more and more emphasis on the variable cost only. It is otherwise called the variable costing. The marginal costing is otherwise called the variable costing. In marginal costing, what happens? The variable costs are treated as a product cost and the fixed cost is treated as the period cost. But in absorption costing, both variable and fixed cost are treated as product cost. That's why it is considered as a demerit or a bottleneck in the system. There are certain key differences between the absorption costing and marginal costing. Absorption costing is a challenging job to implement, whereas marginal costing is simple and comparatively easy to implement. The implementation of marginal costing is very easy, but the implementation of the absorption costing appears to be very challenging. Secondly, the key difference between the two is absorption costing emphasizes on overhead recovery, whereas the marginal costing emphasizes on calculating contribution per unit. Contribution means sales minus variable cost. So since in marginal costing, the variable cost is being given due importance or more and more emphasis given on the variable cost. So the contribution is given more emphasis in case of marginal costing, whereas more emphasis is given on recovery of overheads in case of absorption costing. The third key difference between the absorption costing and marginal costing is the primary consideration is given to each unit cost under absorption costing, whereas the marginal costing gives priority on costing of each additional unit. Additional unit means when the consumption of a particular unit goes on increasing, the additional cost required for each additional unit is called the additional cost. That is otherwise called the variable cost or the marginal cost. That is the third key difference between the two. The fourth one is in absorption costing, both fixed and variable costs are factored into product price, whereas in marginal costing, only variable costs are considered as product cost and the fixed cost is classified as the period cost. The fixed cost component is not taken into the product cost, it is taken as the period cost in case of marginal costing. The fifth important key difference between absorption costing and the marginal costing is the absorption costing is useful for external reporting purpose like government, tax authorities, etc. Whereas the marginal costing is more useful in case of internal reporting like inter and intra-unit references. It is very useful. If we study the marginal costing in detail, please refer to the slides. Marginal costing is a technique. Here it is given. Marginal costing is a technique which is considered with the changes in cost and profits resulting from changes in the volume of output because of variable cost. It is otherwise known as the variable costing. And only the variable costs are regarded as the cost of the products, while the fixed costs are treated as the period cost, which will be incurred during the period regardless of the volume of output. The fixed cost is that cost which remain constant over a certain degrees of production and over a certain period of time. Thereafter, it may change, but normally it remains constant for a certain period of time over a certain volume of productions. That's why it is called fixed cost. If we refer to the characteristics of marginal costing, the first characteristic of marginal costing is it helps management in taking many managerial decisions, and it is not independent system of costing such as process costing or job costing. This is the first characteristic of marginal costing. The second characteristic of marginal costing is all elements of cost, that means production, factory cost, administration and selling and distribution costs, are classified into variable and fixed cost. Earlier we have discussed that there are three types of overheads. One is the production or factory overhead, the second one is the administrative overhead, and the third one is the selling and distribution overhead. Each overhead is segregated into two major segments. First one is variable, second one is fixed. And even there are semi-variable costs are involved in it, which are analyzed into fixed and variable costs. The third characteristics of marginal costing is the variable cost or the marginal costs are regarded as the cost of the products, and the fixed cost is being treated as the period cost. It is not included in the cost of the product. Fixed costs are treated as period cost and are changed to profit and loss account and are charged to profit and loss account for the period for which it is incurred. The next characteristic of marginal costing is the stocks of finished goods and work in progress are valued at marginal cost only. Fixed cost has nothing to do with the valuation of that. Then the prices are determined on the basis of marginal cost by adding contribution. Contribution, which is excess of sales or selling price over marginal cost of sales. Contribution is, there is an equation for contribution. Sales minus variable cost is called the contribution. So the prices are determined on the basis of the marginal cost by adding contribution, which is the excess of sales or selling price over marginal cost of sales. Then assumptions of marginal costing. There are certain assumptions which are taken into consideration for marginal costing purpose. The first assumption for marginal costing is all elements of cost, production of factory costs, administration and selling and distribution costs are segregated into variable and fixed cost. Each and every component of overheads are segregated into two aspects. One is the fixed cost, another is the variable cost. Second assumption is variable costs remain constant per unit of output irrespective of the level of output and thus fluctuates directly in proportion to the changes in the volume of output. The variable cost is that cost which varies directly and proportionately with the volume of output. It has nothing to do with any other aspect. That means if 1 CFT of wood is being consumed for producing one table, when we are going to produce the second unit of table, then the same amount of wood, same CFT of wood would be required for production of the second unit. If you go for third unit, that is also same. That is called the variable cost remain constant per unit of output irrespective of the level of output and thus fluctuates directly in proportion to changes in the volume of output. Exactly, it varies directly and proportionately. The third assumption in case of marginal costing is the selling price per unit remains unchanged or constant at all levels of activities. It doesn't vary with the levels of activity. The fourth assumption in case of marginal costing is the fixed costs remain unchanged or it remain constant for the entire volume of production. Of course, the fixed cost is supposed to remain constant for a certain degrees of production whereafter it ought to vary, but we used to assume that the fixed cost remain unchanged or constant for the entire volume of production, which we are rather do. The fifth assumption is the volume of production of output is the only factor which influences the cost. That means when the volume of production or output goes up or goes down, that will definitely influence the cost because the fixed cost per unit either it will go up or it will go down. Then the next item is contribution. Contribution is the difference between the sales and variable cost. Why it is called contribution? Sales minus variable cost is the contribution. Why it is called contribution? Because that part, that contribution contributes towards recovery of the fixed cost from in the costing system. So that's why it is called contribution is the difference between sales and variable cost. It also may be defined as the excess of selling price over variable cost per unit. Examples. Selling price of a product is say 20 per unit and the variable cost is 15 per unit. So obviously the contribution would be 20 minus 15, so 5. So contribution is equal to sales minus variable cost which is otherwise called the marginal cost. Contribution, there is another equation for contribution. When the contribution is calculated per unit, then the selling price per unit can be this variable cost per unit has to be deducted from the selling price per unit. That would be the contribution per unit. Then advantages of contribution. This contribution, which is exclusively in regards to the variable or marginal cost of the product, it has got certain advantages. The calculation of contribution has got certain advantages. 6 advantages it has. The first advantage is it helps the management in fixation of selling price. Because when we know the amount of fixed cost which remain constant, its unit cost can be calculated, and when we determine the cost contribution per unit, then for taking a decision in respect of selling price, it became easier on the part of the management when the contribution is arrived at in an advance. So the second advantage of contribution is it assists in determining the break-even point. We'll discuss by a numerical example. I'll let you explain that how it assists the determination of the break-even point. Third one is it helps the management in selection of a suitable product mix. It helps the management in selection of a suitable product mix. Means suppose there are two products, one is product A and product B. There are another product mix is a product C and product D. So which product mix should be helpful to the management? That decision has to be taken, and that calculation of contribution facilitates in taking a decision like this. Fourth one is it helps in choosing from the alternative method of production the method which gives highest contribution for limiting factor is adopted. So when we are in a position of calculating the contribution, which is the resultant of the marginal costing, where the variable cost is given due emphasis for that, in that juncture, the alternative method of production, suppose in one method of production, our cost is going up, and in the other method of production, or we are reducing the cost of production, in that case, we can take a decision, we would be in a position to take a firm decision that which alternative method of production should be adopted and which one should be avoided. The fifth one is it helps the management in deciding whether to purchase or manufacture a product. Suppose we are producing TV. There are different components are utilized in or bringing a TV set into its final shape. And when the TV is prepared, finally it has to be fitted with a cabinet. Suppose when the cabinet is prepared in our own factory, by taking the volume of marginal cost into consideration, we came to a conclusion that its cost in our unit is coming 1,000 rupees. If the same cabinet we are able to buy from an outside agency or from an outside firm at a lesser price, say at 900 or 800 or 750 or whatever it may be, then it would be better not to produce that cabinet in our factory than to go for buying the cabinet from the other factory and fitting the cabinet to the other parts of the TV and to give it for a finished product. So it helps the management in deciding whether to purchase or manufacture a product. Sixth, it helps in taking a decision as regards adding a new product in the market. When the management is in a juncture of launching new products in the market, then this contribution can help a lot for taking a decision whether the new product has to be launched in the market or it has to be deferred, or we should withdraw the idea, or we should abandon the idea of launching the new product in the market. The equation contribution, as said earlier, it is sales minus variable cost. And variable cost plus contribution is otherwise the equation if we changed altogether, then the sales is equal to variable cost plus contribution, or the sales is equal to variable cost plus fixed cost plus minus profit, or the sales minus variable cost is equal to fixed cost plus minus profit. If we make an anatomy of the marginal costing, if we look to this, suppose I will be giving a very simple example about the marginal costing and the output, the break-even analysis, which is the outcome of the marginal costing or the variable costing. Suppose there is a coffee bar. In case of a coffee bar where the coffee is being manufactured and it is being sold to the public, in that coffee bar, suppose the details of the variable cost per cup of preparation of per cup of coffee, say the variable cost, there are different components involved in preparation of the variable cost. One is say milk. Milk, the cost of the milk per cup of coffee is say rupees 3. And for sugar, it is say rupees 2 per cup of coffee, I am telling. And the cost of the coffee per cup of coffee is 2 rupees 50 paise. And for other variable cost, it is say 50 paise. So the total variable cost in entirety per cup of coffee comes to 8 rupees. And the fixed cost per month, there are 3 components involved in fixed cost set. The rate of the cabin where the coffee is being produced or manufactured, that is 1,500. And the higher charges of utensils, suppose he has not purchased the coffee, shop owner has not purchased the utensils by its own, he has hired the utensils. When the utensils have been hired, some higher charges have to be paid for that. Suppose 600 is being paid towards higher charges of the utensils. And the third is wages. A person is there who has to prepare the coffee and to serve it to the public, to the customers. He is taking say 900 per month. Accordingly, 1500 for cabin rent, 600 towards the higher charges of utensils, and the wages is 900 per month. The total is coming 3000 per month. If the month is consisting of 30 days, then the fixed cost per day would be 3000 divided by 30, it would be 100 rupees. So the fixed cost per day would be 100, and the variable cost like milk, sugar, coffee, and others. In the other components, you can include your fuel, etc., which are the petty items required for the preparation of the coffee before it is being ready for distribution. Or you can say it can include the price of the cup, the use and throw. Cups may be used for serving coffee to the public, and it may include that. So it is all the last item, the 50 paisa, includes all the other items which are variable in nature, and the total variable cost: milk is 3, sugar is 2, coffee is 2 rupees 50 paisa, and other items is coming 50 paisa. So the total is coming 8 rupees. Total variable cost is 8 rupees, and the fixed cost per day is coming 100 rupees. Presuming that there are 30 days in a month, and the total fixed cost as given in details is 3000 rupees. And the selling price of the coffee is given taking the market into consideration, that 12 rupees per cup of coffee. At this juncture, this is the simplest form of marginal costing, the example of marginal costing where we can determine the break-even of the product. Break-even, we can arrive at the break-even point. In order to arrive at the break-even point, there is an equation or there is a formula. The fixed cost has to be divided by the contribution. Contribution, as discussed earlier, it is the sales minus variable cost. And here we are given with sales figure which is 12 rupees per cup of coffee. And the variable cost is given the 8 rupees per cup of coffee, 3 plus 2 rupees 50 paisa plus 50 paisa, it is coming 8 rupees. So the contribution per unit for each cost unit or per cup of coffee is coming, the contribution is coming sales minus variable cost, that means 12 minus 8 is equal to 4. If the contribution is 4 and the sale price is 12 and the variable cost is 8, which gives rise to the determination of the contribution, and the contribution comes to be 4 rupees. Then if at this juncture, if somebody asks us that how many cups of coffee should be sold by the seller, by the coffee shop owner to be at break-even. Break-even means the point where there is no profit, no loss. That means total of revenue is equal to total of expenses. Total expenses or the total cost. Total cost means it includes the fixed cost. It also includes the variable cost. While manufacturing coffee, the variable cost is 8 rupees per cup of coffee, and the fixed cost is to be determined on the basis of the what is that, the days involved in a period of 1 month's time. So when we go to calculate the break-even of the coffee shop owner, the fixed cost ought to be divided by the contribution per unit. Here, the fixed cost is 3,000 per month, means if it is 30 days in a month, 30 working days are there in a month, then the per day fixed cost comes to 3,000 divided by 30, it comes to 100 rupees. So 100 rupees is the fixed cost and the contribution per unit is coming 4 rupees. When that fixed cost is divided by contribution, it comes to 25 units. That means when the coffee shop owner is able to sell 25 units of cups of coffee per day, it will be at break-even. That means its total revenue would be equal to total cost, or you can say there is no profit, no loss. When 25 units are sold at a rate of 12 rupees per cup of coffee, so 25 into 12, it is coming how much? 25 into 12. Let us calculate. 25 into 12, it is coming 25 into 12. It is coming 300 rupees. When 300 rupees is coming as the total revenue, let us see whether the total cost is equal to that or not. Total cost is coming is the combination or the composition of the fixed cost and variable cost. The fixed cost would be 100 per month, 100 per day as determined earlier. And for determination of variable cost, which is 8 rupees per unit for 25 units, 25 into 8, it would be 200 rupees. So 200 rupees is the variable cost for 20 cups of coffee, and 100 rupees is the fixed cost for how many cups of coffee? For 25 cups of, for a day. So if the owner is able to sell 25 cups of coffee, then it would be at break-even and there won't be any profit in the hands of the organization. Neither there would be any loss in the hands of the organization, because the total of revenue is equal to the total of cost. It also facilitates in taking a decision making. The decision making means, suppose the volume of output, you want to earn a desired amount of profit. The desired amount of profit means, suppose the owner desires to earn a profit of rupees 200 per day. In the earlier calculation, it is determined that if he is able to sell 25 units of coffee, then there won't be any profit in the hands of, neither there would be any profit in the hands of the organization or in the hands of the coffee shop owner, nor there would be any loss. But since one is engaged in doing some business, then he must have certain expectation. And the expectation is he want to manage the show if there is a profit in its hand to the extent of 200 rupees. That means the desired amount of profit in the hands of the coffee shop owner, say it is 200 rupees per day. In that case, we need to find out that how many cups of coffee should be sold at least in a day to earn a profit of rupees 200. When that be the case, that can also be computed. The absorption costing will not help us for computation of this fact, but this can only be calculated through the marginal costing. In case of marginal costing, we can add the desired amount of profit for determination of the volume of output to earn a daily profit of rupees 200. The desired amount of profit need to be added to the fixed cost. The fixed cost is 100 rupees here per day, and the desired amount of profit per day is 200 rupees. 200 plus 100, that comes to 300 rupees. The entire amount has to be divided by the contribution per unit to determine the amount of profit, the amount of units, the number of units to be sold in a day to earn a profit of rupees 200. It comes to 100 plus 200, that is 300. 300 divided by 4, it comes to 75 units. That means if 75 units of cups of coffee are being sold in a day, then the amount of desired profit, that is 200, can be earned by the coffee shop owner, because the sales would obviously more than the cost to the extent of 200 exactly per day. Let us check out. If 75 units are sold, then the selling price is rupees 12. So 75 into 12, it comes to 75 into 12. 75 into 12, it comes to 900 rupees. And the cost would be, there are two types of cost here. One is variable cost and another the fixed cost. Fixed cost is 100 per year, and the variable cost would be 75 into 8. 8 would be the variable cost per unit, and this would be 600. 600 plus fixed cost is 100, 700, and the selling price for all the 75 units of cups of coffee would be 900. 900 minus 700, the total cost. So the resultant would be the 200, which is the desired amount of profit in the hands of the entrepreneur or the coffee shop owner. So this marginal costing, which is otherwise called the variable costing, has got immense power to help the management for taking various decisions whenever it is so desired. Essentially, there are two types of costs that the business faces. One is, as we discussed, one is the variable cost, which vary proportionately, directly and proportionately with the sales. The examples of variable costs are as given here: hourly wages, utility costs, raw materials, etc. If we represent in a graph, in a diagram, the variable cost, the unit of sales is measured in the x-axis and the costs are measured in the y-axis. Then the total variable cost will be in an upward trend, because when the number of units goes on increasing, number of units produced goes on increasing, the total variable cost will also go on increasing in a proportionate manner. That's why the variable cost, which starts from 0, from the corner of the x-axis and y-axis, it goes on increasing slightly in a upward trend, because that is the total variable cost. Inversely, if we represent the total fixed cost line in a graph and measures the same cost in the y-axis and unit of sales or unit of production in the x-axis, then it would be just parallel to the x-axis, the total fixed cost line, because it remains constant with the degrees and volume of production. It has no effect on the changes in the degrees and volume of production. This is the diagrammatic representation of the variable cost as well as the fixed cost. The variable cost and the total cost, the variable cost and the total cost and the fixed cost. The fixed cost, in other hand, in other words, the fixed cost is which are constant over a relevant range of sales. And the examples of fixed cost are executive salary, the salary of the foreman or the salary of the executives, etc. Lease payment, lease rent, depreciation, all these are examples of factory rent. All these are examples of fixed cost. It remains constant without any variation thereof. So if we discuss about the marginal costing, marginal costing help us in various decision making aspects which can never be overemphasized, because so many decisions can be taken through this marginal costing system. This variable cost, which helps in calculating the marginal costing, is immensely beneficial for the management for taking so many decisions from time to time. As given as per the examples of the coffee bar given to you, the break-even point can be simply calculated, which comes to be 25 units, and at the same time, the desired amount of profit, which is to be fixed at 200 rupees, then we have calculated that 75 units of cups of coffee should be prepared per day to earn the desired amount of profit. In the third situation, suppose there is a bank nearby to the coffee shop, and the bank has given an offer to the coffee shop owner that they will consume 50 cups of coffee per day, 50 cups of coffee per day in both the morning session as well as in the evening session, but they make the bargain, or they fixed the selling price not at rupees 12, they fixed the selling price at 10 and ask the coffee shop owner to let them know either the proposal is acceptable or is rejectable. Then the coffee shop owner has to take a decision whether this offer is to be accepted by him or not. Here, let us see. This decision we can firmly take, taking the marginal costing into confidence. Here, if we are at a stable position of selling 75 units of cups of coffee, whereby we are earning 200 rupees per day as our profit. At this juncture, when we got an offer from the bank to produce or to provide them 50 cups of additional cups of coffee per day with a lesser price of 2 rupees from the standard selling price. Now, we had to take a decision whether to accept the offer or to reject the offer. Now we can say that if additional 50 cups of coffee are being have to be produced and to be provided to the bank, we need to see that the fixed cost will remain constant for this, because no need of hiring extra utensils, no need of paying extra rent for the cabin, no need of paying extra wages to the salesman, because the salesman who is there, who is preparing the coffee as well as to serving the coffee to the customers, he is getting 900 rupees. So in any way, the fixed cost of 3,000 per month, it remains stagnant or constant. But the variable cost ought to vary with the volume and degrees of production. When you are producing 75 units, the variable cost per unit was 8. The variable cost per unit will remain same if we are producing additional 50 cups of coffee also. So in that case, if we accept the offer of producing extra 50 cups of coffee, then the variable cost would be, the extra variable cost would be 50 into 8. That means 400 rupees. And the fixed cost will remain constant. That means no additional fixed cost or fixed expenses has to be incurred by accepting the offer. It will remain 3,000 per month. And when it remains 3,000 per month, obviously it will remain constant with 100 rupees per day. When the fixed cost is 100 and that has already been observed, it is being fully covered by the contribution with the 25 units when we are attaining the break-even. And when we are selling 75 units, it is giving us a profit of rupees 200. Over and above that, when we got the offer of 50 cups of coffee to be provided to the banker, to the nearby bank, at a price of rupees 10, then no extra fixed cost has to be incurred by us. Only the extra marginal cost of 50 cups of coffee has to be calculated, and that comes to 8 into 50. That means 400 rupees. And the selling price for 50 cups of coffee would be 12 rupees. Instead of 12 rupees selling price, the bank has fixed the selling price at rupees 10. So for 10 per cup of coffee, when it is 10 per cup of coffee, for 50 cups of coffee, it would be 500. And for 500 cups of coffee, the selling price for 50 cups of coffee would be 500. And the extra additional cost or the extra marginal cost or the extra variable cost incurred for 50 cups of coffee would be 50 into 8, that would be 400. That means the contribution would be contribution in respect of that additional 50 units of 50 cups of coffee or 50 units of coffee would be, selling price would be 500 and the contribution would be 400. It gives an additional contribution of rupees 100. So when we refer to the advantages of the contribution, see here, the advantages of the contribution as listed here. It helps the management in fixation of selling price. It assists in determining the break-even point. It helps the management in selection of a suitable product mix. It helps in choosing from the alternative method of production the method which gives highest contribution per limiting factor is adopted. It helps the management in deciding whether to purchase or manufacture a product. It helps in taking a decision as regards adding a new product in the adding or launching of a new product in the market. So these are the advantages of the contribution. So here, through contribution only, we are able to calculate or we are able to take a decision whether 50 cups of coffee, additional 50 cups of coffee can be sold to a banker at a lesser selling price of rupees 2 than the standard selling price of rupees 12. But at this juncture, if our normal selling price is going to be affected, what would be our decision? Suppose our customers came to know that we are selling the same cup of coffee, same quality of coffee to the banker at a price of rupees 10, whereas we are charging it to the individual customers at a price of rupees 12, and we are having the regular customers of 75 who are consuming 75 units of coffee per day. In that case, what would be our decision in the respect? That means 75 cups of coffee gives us a profit of rupees 200 if the selling price is reduced to 10, because the bank has reduced this selling price to 10, and if the other customers demands like this, then what would be the fate of taking a decision like this? In that case, for 75 cups of coffee, the selling price would be 750 if it is reduced to 10, right? 75 into 10. And the variable cost would be 75 cups of coffee into 8, the variable cost per unit, that comes to 600 rupees. 600 rupees is the variable cost and 750 rupees is the selling price. And the fixed cost would be 100 rupees. The variable cost is 600 and the variable cost is 600 and the fixed cost is 100. That means it is 700 rupees. The total cost is 700 rupees and the sale is 750 rupees. So 750 minus 700, the profit is 50 rupees. The profit is 50 rupees. That means it reduces the profit by 100 rupees. Sorry, 150 rupees. Earlier the profit was 200 rupees. Now the profit is reduced to 50 rupees. Reduced to 50 rupees. That means then a reduction on the volume of profit to the extent of 150. So when we are accepting the offer of the bank, we are getting an additional profit of rupees 100, and here we are losing the profit of 150 from the existing customers. That means there is a net loss to the extent of 50 rupees. So in that case, our decision would obviously undergo a change. That means when we are changing the decision, we are changing the decision at that juncture when the reduction in the selling price per cup of coffee is carrying an impact on the public to whom you as or the customer or the coffee shop owner is selling 75 units of cups of coffee per day. If it doesn't carry any impact on the individual customers or the public who are regularly consuming 75 cups of coffee, they are prepared to give us 12 rupees, irrespective of the fact whether we are supplying to the bank at a lesser price, that means at a price of rupees 10 per cup of coffee. But if it carries an impact on the, on the impact on carries a negative or adverse impact on the normal customers or the existing consumers, then we would be at a loss. The net loss figure will go up, will be going up. The profit, we will suffer a loss of rupees, not exactly loss, but our profit will be reduced to the extent of 50 rupees. So in that case, it would not be advisable to go for accepting the offer of the bank, because for producing additional 50 units or 50 cups of coffee, there would be additional burden on the worker, and obviously there would be certain extra effort has to be given for the purpose. But even after giving the extra effort, the net earning is being reduced by 100 rupees. So in that case, it would not be advisable to go for taking a decision like this. So this is only possible with the help of the marginal costing. The marginal costing helps us in taking a decision like this. Then another important factor which is involved in the marginal costing, it is called the PV ratio or the profit volume ratio. The marginal costing can also be interpreted through a diagram. I'm showing you the diagram here. This is the break-even chart. Here the break-even chart, if you refer to in the x-axis, we are measuring the quantity sold, and in the y-axis, we are measuring the costs. There are three lines you can say. One is the fixed cost line, which is parallel to the x-axis because it remains constant irrespective of the volume or the quantity produced or sold. The x-axis, we are measuring quantity produced or sold, and the fixed FC is equal to fixed cost. The fixed cost is constant over the entire period, it is irrespective of the volume of production. That's why it is quite completely parallel to that of the x-axis. Then the variable cost line, it starts from the total revenue. That is the total revenue. TR is the total revenue, and TC, it is the total cost. Total cost means it includes the variable cost as well as the fixed cost. The break-even point is the point of intersection of the total cost with the total revenue. The total revenue intersects the total cost at that point where the circle is given by red color. So that is the break-even point. That means at what point there won't be any profit, there won't be any loss. The red color angle is being shown by the loss area, and the green lined area in the right hand side of the circle of the break-even point, that is the profit area. Profit area means at the point of intersection there is no profit, no loss, and slowly thereafter, when the volume of sale increases, more and more profit is being earned. That is marked with the profit area, and here in the left hand side it is marked with the loss area, and the total variable cost is given here. The total variable cost and total fixed cost, and both fixed cost and variable cost are included therein. That is the total cost. total cost, the point at which the total cost is being intersected by the total revenue line, that is called the break-even point. And this angle is called the angle of incidence. The angle of incidence. In case of angle of incidence, the more wider the angle of incidence, the more profitability in the hands of the organization is more. That means there is a certain rise in the selling. If the gap between the if the selling price is substantially higher than the contribution, then what will happen? The profit, the angle of incidence would be much wider than that of the figure shown here. So more wider the angle of incidence, the profitability position would be higher or would be much more in the organization. So when you look to the chart here, the break-even chart, which is the resultant of the marginal costing, that marginal costing is otherwise called the marginal costing is otherwise called variable costing. Because more and more emphasis is being given on the variable cost and the fixed cost, although it is taken into consideration, but it is presumed or it is assumed to be remaining constant over a certain degrees of production and over a certain period of time. So another technical aspect comes from this, which is called the PV ratio, profit volume ratio. Here, the PV ratio. The profit volume ratio or contribution ratio or marginal ratio, they are one and the same, all the three. The profit volume ratio, PV ratio, or which is otherwise called the contribution ratio, and this is otherwise called the marginal ratio, is the relation of contribution to sales and expressed as under the PV ratio is equal to contribution divided by sales. Since contribution is equal to sales minus variable cost or fixed cost plus profit, it is one and the same. Sales minus variable cost and fixed cost plus profit would be the same figure, and that is what the contribution is. So PV ratio can also be expressed as contribution divided by sales is equal to sales minus variable cost by sales, because variable cost by sales would be the profit volume ratio. Fixed cost plus profit divided by sales, that would also be the resultant of the PV ratio. Fixed cost plus profit divided by sales. Again, change in the profit or contribution. Change means increase or decrease. When there is a change in the contribution, that means when the marginal, the unit, the variable cost is increasing, that definitely it will carry an impact on the position of contribution. And when there is a change in the profit, change in profit or change in contribution, when that is divided by change in sales, that will also be the, that will also give the result of PV ratio to us. Let us take an example for computation of the PV ratio here. The sales is 1 lakh and the profit is rupees 10,000 and the variable cost is 75%. 75%. Find out the PV ratio first and the fixed cost third, the sales volume to year profit of rupees 40,000. In this juncture, if we go for calculation of all the three items, that is PV ratio, sales is equal to 1 lakh as given here. The variable cost is equal to 75% of selling price. That means if the selling price is 1 lakh, then 75% of that is coming 70,000. The PV ratio would be contribution divided by sales is equal to sales minus variable cost by sales. So 1 lakh minus 70,000, the whole divided by 1 lakh. So 30,000 divided by 1 lakh, it would be rupees 30 or 30%. The PV ratio would be 30%. Secondly, contribution is equal to fixed cost plus profit. 30,000 is the fixed cost, because from the when the variable cost is 70,000, that the fixed cost would be 30,000. Profit as given here is 10,000. So fixed cost plus profit, that is also contribution. So it comes to 30,000 minus 10,000. It is fixed cost comes to 20,000. So when we are calculating the fixed cost, profit when it is deducted from the contribution, that would be the that would be the fixed cost. So fixed cost automatically comes to be 20,000 here by deducting 10,000 profit from the fixed cost. And for PV ratio, the fixed cost, the ratio, the equation for the ratio is fixed cost plus profit divided by sales. Here the fixed cost is 20,000. Fixed cost is 20,000 because the fixed cost for profit is 30,000 means profit is 10,000 means obviously the fixed cost is 20,000 as calculated under 2 above. So 20,000 is the fixed cost and the profit is equal to 40,000. When that is divided by sales, it comes to 30%. So 60,000 divided by sales, the PV ratio is 30% here. And when you compute the sales to earn a desired volume of profit of 60,000, desired volume of profit of 60,000, then the 60,000 into, desired amount of profit of which 40,000, then sales is equal to 60,000 into 100 divided by 30, and that comes to 2 lakhs. So the amount of or the volume of sales to be effected by the organization to earn a desired amount of profit should be 22 lakhs. When the sale is 2 lakhs, then obviously the profit in the hands of the organization after deducting the contribution and after deducting the fixed cost from the total volume of sales, it will give rise to a profit of rupees 40,000 in the hands of the organization, because this sales is 2 lakhs and the variable cost, after deduction of the variable cost and after deduction of the fixed cost, the resultant would obviously be 40,000 in the hands of the organization. So this is what the profit volume ratio and the computation of fixed cost and the computation of sales for earning a desired amount of profit can also be ascertained by or through the help of the marginal costing or the break-even analysis. So this is about the PV ratio, which is the resultant of the marginal costing. Thus, marginal costing helps a lot to the management in taking several managerial decision making, which cannot or which is absolutely not possible in case of absorption costing. Absorption costing takes both the cost into consideration, as well, both fixed cost as well as the variable cost, but it doesn't make any differentiation between the two, whereas the marginal cost gives more and more emphasis on that of the variable cost, but it takes both the cost into consideration, but the marginal costing system helps the management in taking a lot of managerial decisions, which is helpful for the management for taking a lot of decisions for future growth and development of the organization. Thanks to all.